Welcome back to the channel. Even with Christmas thinning out the volume, this week still set the tone into year-end. Today we are breaking down the year-end stock rally, mixed US data, and fresh signals out of Japan. So let's start with the biggest story of the week. US stocks stayed supported as the major indexes hovered close to record territory. The holiday shortened schedule kept trading light, but Monday kicked off with a risk-on push that lifted the benchmarks. Midweek, the tape stayed calm and green as traders leaned into year-end positioning instead of de-risking. By Friday, moves were tiny in post-holiday trading, yet the week still ended higher overall. But here is the key point. A grind higher on low volume usually signals confidence, but it can also mask how quickly things can swing when liquidity is thin. So, what does this mean for us? Sentiment was optimistic heading into the final stretch of the year, but any surprise headline could still move prices more than normal. U.S. economic data sent mixed signals to markets this week. Strong headline growth clashed with weakening demand indicators, leaving investors cautiously optimistic but far from euphoric. This chart shows U.S. real GDP growth on a quarter-over-quarter basis, and the key takeaway is resilience. Through 2023 and 2024, growth cooled at times but never collapsed, reinforcing the idea that the economy avoided a hard landing. In 2025, GDP rebounded more clearly, underscoring that activity remained solid despite tight financial conditions earlier in the cycle. That strength gave markets confidence that earnings and demand were not falling off a cliff. But here is the nuance. Strong GDP does not mean everything feels strong on the ground. It set a supportive backdrop for risk assets, while also raising the bar for how quickly policy could realistically ease. This chart tracks U.S. durable goods orders month over month, and it tells a very different story than GDP. Orders have been choppy and repeatedly negative since 2023, highlighting how sensitive business investment has been to rates and uncertainty. Even during periods of solid overall growth, companies pulled back on big-ticket spending. That divergence is important, because durable goods tend to lead the cycle rather than follow it. The weakness here explains why markets stayed cautious despite strong headline growth. It reinforced the idea that the economy was still moving forward, but on uneven footing rather than broad-based momentum. Japan moved back into focus as inflation stayed above target and policy normalization remained on the table. Even subtle shifts in Japanese rates matter because they can ripple far beyond domestic markets. This chart shows Japan's 10-year government bond yield, and the key story is the slow but steady climb through 2024 and 2025. Yields have moved higher as inflation stayed above target and the era of ultra-loose policy began to fade. Even modest increases matter in Japan because they represent a major regime shift after years of suppression. Markets watched this closely during the week, knowing that higher Japanese yields can change global capital flows. If domestic bonds become more attractive, Japanese investors may bring money home. That is why even small moves here tend to ripple through global bond and currency markets. UK growth remained weak, but it did not tip into outright contraction. The data painted a picture of an economy stuck in low gear, leaving markets cautious rather than alarmed. This chart shows UK real GDP growth on a quarter-over-quarter basis, and the pattern is clear. Growth has been shallow and uneven. Since 2023, the economy has repeatedly flirted with stagnation, posting small positive prints rather than a strong rebound. There is no deep contraction, but momentum never really builds. That keeps the UK in a vulnerable middle ground, where policy tightening bites but easing cannot come too fast. For markets, this means heightened sensitivity to rate decisions and fiscal signals. The data confirms an economy treading water rather than moving forward with confidence. Policy uncertainty stayed in the background even during a calm holiday week. Tariffs, deficits, and cost pressures continued to weigh on confidence, shaping a cautious undercurrent in market sentiment. This chart shows the U.S. federal budget deficit, and the scale is hard to ignore. Since 2023, deficits have remained elevated, reflecting higher interest costs, persistent spending, and uneven revenue growth. The level itself is not new, but the persistence is what matters for markets. Large deficits limit fiscal flexibility and keep long-term debt questions in focus. During this week, that backdrop reinforced why investors stayed selective rather than aggressive. It is a reminder that structural policy issues continue to shape market behavior, even when headlines are quiet. Now, zooming in on the big question from the headline segment, is this year-end rally real strength or just holiday smoke and mirrors? On the chart, SPY, the SPDR S&P 500 ETF, is still inside a rising trend channel, and it has held that channel for 3 straight sessions. But here is the key point. Price is sitting right near the floor, about 0.1% above the lower channel line, putting it down in the 4th percentile of the channel. That creates a wild imbalance. There's roughly 2.8% room to the upside inside the channel versus almost no room below, and that asymmetry is huge at about 24-1. Now, the structure is tight, the channel is only about 2.9% wide, and daily ATR is around 30% of that width, meaning a real breakout usually needs an above-average range day to force the issue. This ties back to the holiday vibe, because with thin liquidity, these tight setups can snap faster than people expect. So what does this mean for us? The uptrend is intact, but the market is basically balancing on the lower rail, and any surprise catalyst can decide whether we bounce hard or finally slip out of the channel. At the same time, if SPY is balancing on the lower rail, the next question is whether tech is providing the engine for the bounce or quietly running out of steam. On this chart, QQQ, the Invesco QQQ Trust tracking the NASDAQ 100, is also inside a rising trend channel, and it has stayed in that channel for 3 straight sessions. Here is the punchline. It is pinned near the bottom too, about 0.1% above the lower channel line, sitting down at the 3rd percentile of the channel. So, the setup is simple but intense. There is about 3.4% room to the upside inside the channel, versus almost no downside cushion before you start testing the boundary, and the upside to downside asymmetry is massive at roughly 32 to 1. The channel itself is about 3.5% wide, and daily ATR is around 35% of that width, so it is not frozen, but it still takes real momentum to push out of this range. Now, here is what matters. In a holiday-thin tape, a tech-heavy index sitting on support can either spark a clean rebound or turn into a sudden air pocket if sellers show up all at once. Meanwhile, the question after tech is whether the old economy is quietly confirming the move or starting to lag. On this chart, DIA, the SPDR Dow Jones Industrial Average ETF, has actually been inside its rising trend channel for 18 straight sessions, which is far more stable than what we just saw in SPY and QQQ. Price is sitting right in the middle of the structure, around the 45th percentile, with roughly 1.1% room to the upside and about 0.9% to the downside, so the balance here is almost perfectly even. That tells us something important. Industrials and value names were not panicking during the holiday week. They were simply grinding sideways and respecting both channel boundaries. Daily ATR is about 44% of the channel width, meaning the Dow has enough range to move, but it has chosen calm over drama so far. So, when you step back and connect the dots, the Dow acting steady while tech hugs support reinforces the cautiously optimistic tone of the week rather than flashing a broad market warning sign. Finally, the last piece of the index puzzle is whether small caps are confirming this cautious optimism or quietly flashing stress. On this chart, IWM, the iShares Russell 2000 ETF tracking U.S. small caps, is sitting exactly on the lower boundary of its rising trend channel and has been inside that structure for 5 straight sessions. That is as tight as it gets, with essentially zero room left to the downside inside the channel and roughly 4.4% of room overhead, making this a pure pressure point. The channel itself is solid, with a strong quality rating and a long history of price respecting both bands, and daily ATR is only about a third of the channel width, so any real break would likely need a bigger than usual range day. So, this answers the big question from the Dow scene. Small caps are not breaking down, but they are clearly the most sensitive part of the market right now. If risk appetite expands, IWM has room to snap higher fast, but if sentiment sours even slightly, this is the index that would feel it first. Switching gears, after seeing small caps sitting right on a support rail, the next question is whether pure risk appetite is expanding or staying on a leash. On this chart, BTC-USD, Bitcoin priced in US dollars, is still inside a falling trend channel, and it has been in that channel for 8 straight sessions. The vibe here is very different from equities, because the structure is pointed down even while stocks looked calm and resilient in the holiday week. Right now, Bitcoin sits around the 20th percentile of that channel, with about 10.8% room up to the upper channel line, and about 2.7% room down to the lower line, so there is upside space, but the path is still inside a downtrend. The channel is wide at roughly 13.5% of price, yet daily ATR is only about 23% of that width, which is tight enough that real breakouts usually need a bigger than usual punch. Now, here's what matters. This is the market telling you that speculation is not in full party mode, it is cautious, selective, and waiting for a catalyst to flip the script. Stepping into rates, the question after crypto is whether the bond market is quietly backing this equity calm or preparing a surprise. On this chart, TNX, the US 10-year Treasury Yield Index, has been trading above its falling trend channel for 5 straight sessions. That is a subtle but important shift because the former upper band of the channel is now acting as support instead of resistance. During the week, yields dipped into that boundary and buyers stepped in, pushing them back up and closing above the channel, which shows there is still demand for treasuries at these levels. The structure is tight, with daily ATR only about 21% of the channel width, so this is not a panic move. It is controlled and deliberate. The takeaway here is simple. Rates are no longer collapsing, but they are also not spiking, and that balance helps stocks stay bid without triggering a fear response into year-end. Looking under the hood, the next piece after rates is the US dollar, because this is often the silent driver behind global risk flows. On this chart, DXY, the US dollar index, is still firmly inside a falling trend channel, and it has stayed there for 22 straight sessions. Price is sitting near the lower part of that channel, around the 20th percentile, with only about 0.4% of room below and roughly 1.6% of room back toward the upper boundary. That tells us the dollar is weak, but not collapsing, and the structure remains controlled rather than chaotic. Daily ATR is only about 22% of the channel width, which means volatility is muted, and any real reversal would likely need a stronger catalyst. The bigger message is clear. A softer dollar during the holiday week quietly supported risk assets and helped keep the overall mood constructive instead of defensive. Turning to safety, the question after the dollar is whether investors were hedging quietly or preparing for real trouble. On this chart, GLD, the SPDR Gold Shares ETF, has been trading above its rising trend channel for 3 straight sessions. That breakout is being respected, because the former upper band has flipped into support and price dipped into that level and bounced right back. Gold is sitting about 1.8% above the channel, which shows strength, but the structure is still controlled rather than explosive. Daily ATR is only about 22% of the channel width, so this is not panic buying, it is steady accumulation. The message here is subtle but important. Gold's strength alongside calm equities points to cautious optimism, not fear, with investors keeping protection on without abandoning risk. On the other hand, after seeing gold attract quiet protection flows, the question is what growth-sensitive assets are saying about demand expectations. On this chart, CLTUF US crude oil futures are still inside a falling trend channel and have stayed there for 5 straight sessions. Price is sitting near the lower end of that structure around the 14th percentile, with about 1.2% of room below and roughly 7.1% of room back toward the upper channel line. That imbalance shows downside pressure has eased, but the trend itself has not flipped yet. Daily ATR is about 29% of the channel width, so the structure is tight and any real upside break would need a stronger catalyst. The takeaway is clear, oil is not signaling panic, but is also not confirming strong growth optimism, which fits perfectly with the cautious late-year market mood. Shifting focus into mega-cap leadership. The question after commodities is whether the biggest stocks are still steering the market forward or starting to hesitate. On this chart, AAPL, Apple Inc., is trading below its rising trend channel and has stayed there for 9 straight sessions. Price is sitting about 3.0% beneath the lower boundary, and that former support has clearly flipped into resistance. The channel itself remains strong in the bigger picture, but this stretch below it shows momentum has cooled compared with earlier in the year. Daily ATR is only around 29% of the channel width, so the move lower has been controlled rather than panicked. The takeaway is straightforward. Apple is not breaking down, but it is no longer pulling the market higher, which helps explain why the broader tape felt calm and cautious instead of aggressive during the holiday week. Zooming further into tech leadership, the follow-up after Apple is whether any of the giants are quietly coiling for a bigger move. On this chart, MSFT, Microsoft Corporation, is flashing a TTM squeeze, meaning volatility has been compressed for 8 straight sessions. The daily trading range was about 63% smaller than the recent average, which is classic calm before a potential expansion. Short-term bias still leans bearish, but buyers clearly showed up into the close, with price finishing in the upper quarter of the day's range. That combination matters because it tells you selling pressure is not aggressive, even if momentum has cooled. The takeaway here is simple. Microsoft is winding up, and once volatility expands, it could quickly reassert leadership or confirm a broader pause in megacap momentum. Meanwhile, the final check inside megacap tech is whether the former momentum leader is cracking or quietly regaining control. On this chart, NVIDIA Corporation, is showing a failed attempt to make a new low, which is a classic sign that buying power is stepping back in. After an inside day, price broke higher, printed a bullish gap and go, and closed at the highest level in 29 trading days, confirming short-term strength. Even though there was a shooting star candle near resistance and the pullback from the last high is still about 10.2%, that size of retracement has happened multiple times this year without breaking the trend. Buyers have closed the market higher 3 sessions in a row, and on balance volume just hit a new 20-day high, pointing to accumulation rather than distribution. The message here is powerful. NVIDIA is volatile and emotional, but right now it is acting like leadership that is correcting within strength, not rolling over into weakness. Taking a step back, the final question after watching leadership in commodities is how much fear is actually priced into this market. On this chart, VIGs, the CBOE Volatility Index, has stayed below 20 for 22 straight sessions, which is a long stretch of calm by any standard. Volatility is crushed, the tape looks almost sleepy, and traders have clearly grown comfortable as the year winds down. That kind of quiet can feel reassuring, but it also means protection is cheap and complacency can creep in fast. The key takeaway here is balance. Low volatility supports the rally narrative, but it also raises the stakes if an unexpected catalyst hits a market that is no longer braced for impact. Wrapping it all together, the big question after watching volatility stay crushed is how to frame this market going into the next stretch. Across indices, leadership, rates, and commodities, the message from this week was consistency, not excess. Trends are mostly intact, pullbacks look controlled, and risk appetite is selective rather than reckless. That combination fits a late-year environment where positioning matters more than headlines and patience beats prediction. The smart read here is respect the calm, stay alert for expansion, and remember that quiet markets often move the fastest once the balance finally breaks. And with that, we are at the end of a very calm but very telling holiday week. The market did not panic, did not chase, and did not break, and that says a lot about underlying confidence. Heading into the next sessions, stay flexible, respect the trends, and do not underestimate how fast conditions can change after long stretches of quiet. If you found this breakdown useful, hit the like button, subscribe for more weekly market reads, and I will see you in the next one.